Hello friends, we'll be discussing certain details about how to solve a problem which is related to joint life policy. In the previous video, we've already understood what are the details that we have to take into consideration whenever we have to go through a joint life policy. Now, this is the time when we'll understand that the same joint life policy will be put into practical approach here. So let's go through the illustration first and understand how to get this problem solved. But before that, what we'll be doing is that we'll be going through certain journal entries so that we can reiterate the same scenario or the same thing. So before we could go through the complete illustration, let us understand the first journal entries that we have early understood in the previous videos. Now, in this specific scenario, what we'll be knowing is that what is the first accounting entry that we have to pass. So the first thing that we have to do, or the first entry that we have to pass here, is the payment of joint life insurance premium. That means the premium which is part of an expense that we pay up. Now, this accounting entry will be joint life premium policy account debit to bank account. I have mentioned in the short form as JLP. Now, the second thing that we'll be doing is that this expense which has been made out of the bank payments, this has to be charged to the profit and loss account. Hence, profit and loss account will be debited and the specific expense will be credited here. Rather, we can close this expense account. If we can see the entry that we have passed here, premium account which was debited earlier has been credited. That means the premium account has been neutralized or cancelled, and profit and loss account has been debited with the same expense. That means we have incorporated this expense into the profit and loss account now. Now let's go to the last entry of the accounting year. Now the third entry that we'll be passing here is when the maturity comes into the picture. So either is the insurance company that will be debited or the bank account that will be debited. That means either the company that is paying up, that means the insurance company, that will be either debited, debit the receiver, credit the giver, something like this, and the bank account, either of it, because the money is coming into your bank account, hence bank account or the asset side will be increasing. So that account will be debited and the individual partner's account will be credited here. Now there are two conditions that we have to further understand whenever a premium amount is paid. If it is paid as a part of an expense, the previous journal entries that we just understood are supposed to be passed. But if the same amount is considered as an asset, then what? However, the amount that is paid up as a premium, if it is in excess of the surrender value, then what happens? And if it is less than the surrender value, then what happens? If it is in excess of the surrender value, that means whatever amount you're supposed to get at the day of the maturity, if it is more than that, the premium that is more than that, then that is a loss and that is transferred to profit and loss account. However, if the surrender value is more as compared to the premium that you're paying up, then in such a scenario, you receive an income or a profit and that is moved to partner's capital account individually in the profit sharing ratio. Now this is the pattern that you have to follow. Now on the basis of this itself, we'll start with the illustration. Now we have the illustration right in front of you. We have mentioned all the details and let's go through those details one by one to understand how this illustration is supposed to be worked out and what are the basic details provided in this illustration. The illustration states that R, W and B shared profit and losses in the ratio of 5:3:2. They took a joint life policy in the year 2007 for 50,000 rupees. Premium of 3,000 was paid annually on 10th of June every year. The surrender value as of 31st December for various years was provided as mentioned below, for which starting from 2007 it was nil, 2008 it was 900, 2009 it was 2,000 rupees, 2010 it was 3,600 rupees. So these are the surrender values that were mentioned here. Now in this question they mentioned that the B retires here on 2011, 15th of April. Now if you see, the first entry that we have passed here is the first part, the entry that we had passed, joint life policy premium account debit to bank account. So if you can see, joint life policy account was debited on the debit side, we have mentioned to bank account here. And the second entry that we used to pass, that means charging it to profit and loss account, that entry, profit and loss account debit to joint life policy premium. So on the premium side, on the credit side, we have mentioned it as profit and loss account. Simultaneously, we'll go ahead and mention all the further entries, but considering the surrender value as the balance carried forward, or the balance which is supposed to be carried down, because that is the balance and the difference is supposed to be paid as the premium that we are supposed to pay. That means if 3000 is the annual premium and the surrender value for that year is 900, that means the difference between them is 2100. That is the premium that will be paying up. So that's the reason surrender value is taken into consideration. So if you can see, we have mentioned the same thing here. The balance that is carried forward is the surrender value for 900, which we have mentioned, and the same thing was mentioned in the question as the balance of 2008 is 900. So this balance will be carried forward in the next year, and that will be the starting point of it. If you can see, for the year 2009 also, we have mentioned the balance has been carried down further, that is 900. The premium that has been paid has been mentioned on the debit side as 3000. So the total of the debit side is 3900. Now accordingly, you have to figure out what is the total on the credit side. But before that, you need to make sure that the surrender value is mentioned first. So if the 2000 is surrender value of this specific year and 3900 is the account balance, so the balance 1900 is the premium that we have paid ideally. So according to this, we have to understand that this is the balance that is charged to profit and loss account. We may be paying premium of 3000 annually, but what is the balance that we are charging to profit and loss account is this kind of balance difference. That means the surrender value has to be first subtracted from the debit side, and whatever balance is left, that is supposed to be charged to profit and loss appropriation or profit and loss account. Now even for the year, that means 2010, the last year, where the premium amount has been paid up as 3000, the balance has been carried down from the previous year as 2000. That brings the total of 5000 on the debit side. And in that year itself, the surrender value was mentioned as 3600. The profit and loss appropriation here is 1400, and that is supposed to be carried forward in the year 2011. That has been done. Now in the last year, 15th of April 2011, this specific person B retires. That means the maturity is cancelled there. So whatever amount that we mentioned, or the last entry that we had mentioned here, that means insurance company account debit or bank account debit to individual partners capital or the joint life policy here is supposed to be passed. That means policy premium that was debited, debit what comes in bank account will be debited, and premium account that is getting cancelled now will be credited. So that is the 3600 surrender value, because in 2011 it was done. So that is the same amount that has been mentioned here. We have prepared the profit and loss account, rather we can say we have prepared the joint life policy premium account here. Let's go ahead and prepare the profit and loss appropriation account or the profit and loss account for the all 4 years now. Now if you can see, we have prepared the profit and loss account as well. The only difference is that we just have to post the entries that we posted on the joint life premium account on the credit side. That has to be moved here every year. So this has been done, and this is how you prepare a joint life policy premium account, rather than understanding whenever these kind of details are mentioned. This is the only way, the only game runs around here is on the journal entry. So you need to make sure all these details are followed up and all these details are done in a specific manner. So understand, whenever a joint life policy is given, 3 things are very important: the journal entries, the surrender value, and the date of retirement, because on that date itself you have to calculate the other moves of your specific illustration or your sum. So I hope this example or this illustration gave you a lot of clarity about how to deal with joint life policy problems and how to pass on the journal entries using the same kind of format which is used for the other kind of account preparation or ledger preparation. So thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.